Let me just paint you a quick story. On New Year's Eve 1999, the UK share index, the FTSE 100, stood at 6,930. Roll on 20 plus years and the index stands at 6,400. Not only is that lower, but it's 6% lower. Basically, if you invested in an index tracker 20 years ago, you would have lost money, and that was 20 years worth of investing in the UK's biggest company. So what's the deal? Why bother investing at all? Well, this is where the importance of dividends comes in, those lovely income checks that just keep rolling in month after month. So in this video, let's see how we can best choose the most reliable dividend stocks and hopefully retire with a decent passive income. I'm Anthony, and we're talking money. Stocks whose price is lower in 20 years' time than today may seem like a dead cert disaster. After all, we buy shares that will hopefully go up in value, don't we? But in this scenario, it would be like owning a rental house that goes down in value, but without taking into consideration at all the monthly rent that we get. There are always two components to any asset: its value and its yield or return, or interest, whatever you want to call it, or dividend. Without one of these two components, there must be the other, and ideally both. When you look at both value and dividend, you get the total return from that share or asset. Now, did you realise that over the last 20 years, that same 20 years, even though that basket of shares in the FTSE 100 has lost money, the dividends that those same companies paid you would amount to a total return of over 100%. I know, it's hard to believe that simply reinvesting your dividends back into your investment, your portfolio would have doubled in value, even though that those same shares went down in price. It's quite amazing, and that's the importance of dividends. If you're going to go investing for the long term, it really doesn't matter too much what happens to the underlying price. It's the case of tails you win, heads you win too. So the key is to know how to choose these stocks that pay a decent, reliable dividend. Now, you could of course buy an index tracker like Vanguard FTSE 100 tracker, which I hold personally, and there's absolutely nothing wrong with that at all. You can invest in this using a free commission broker like Freetrade or Trading 212, or with Vanguard themselves on their website. But as with all things in life, if you want to get a greater return, then you need to carry a slightly greater risk, and that's where choosing individual shares comes in. Dividend stocks provides one of the easiest passive forms of income. In theory, you just buy some shares that pay out a great dividend and sit back and wait for those juicy dividend checks to roll in. Well, in theory, that's right, but it's best to avoid some obvious mistakes first. After all, we don't want to take any unnecessary risk with our money. Firstly, what is the definition of a dividend stock? After all, most shares pay a dividend. It's one of the main ways a company attracts itself to the market, but not all dividend stocks are the same, and some may look good, but actually a bit of a trap for your money. Right then, the characteristics of a good dividend payer, in my opinion, are as follows. Firstly, check that the company is paying a dividend greater than the current level of inflation. I wasn't going to put this one in here on this list, to be honest, because I thought it was too obvious, but actually it's not that obvious. In order to build wealth, you need not to lose money to the effects of inflation that erodes the value of your wealth. Currently, inflation is running, say between 1 and 2%, depending on what basket of goods you take. So a good dividend stock needs to pay you at least 2% or more. If you want to compound your dividends to build real growth over a lifetime, then the greater the dividend yield, the faster you'll reach your desired income from your portfolio. Don't, however, be tempted to buy very high dividend stocks that pay double-digit yields, as these can hide problems with the company. A recent price drop because of a poor set of results will make a yield look fantastic, but your dividend may not be sustainable if there are problems ahead. Right then. Secondly, check that the company's been around for some time. After all, you don't want a company that's here today, gone tomorrow. So in order to establish a long income stream in the future, then there is an argument that a good dividend stock is actually pretty boring. Fast-growing companies tend not to make good dividend stocks because all their high growth tends to mean that either cash flow is tight, leading to less available for dividend distribution, or debt levels are higher to fund that rapid growth. So what else do we need to check for a good dividend stock? Okay, right. Next thing to do is to check that the earnings, that's profits, are growing year on year. To have a growing dividend, we need a growing level of profits. Companies that have a fluctuating profit level may not be able to support that long-term steady stream of dividends that you can compound over time. Again, it's better to have a boring company that grows its profits, say 5-10% year on year, rather than having a company that's growing profits at say 30% one year, a loss maybe the next, and maybe a little bit after that. The next thing I look for in the accounts is a strong cash flow per share. Legally, dividends are distributed earnings, i.e. if there's no retained profits in the company, it can't declare or distribute a dividend. But in practice, dividends are actually distributed cash from the company's bank account. That cash comes from making a profit and getting that cash from the customer, or if it's not forthcoming from the customer in a timely manner, then that cash comes from borrowing. So a good dividend stock is good at generating strong cash flows from its profits. This figure is the cash flow per share ratio. Now, if you want a figure on this, the figure is the cash flow per share ratio, and this should be equal, or better still, be greater than the dividend per share. If it's less than the dividend per share, it can only be funded by borrowing, and that's not a good state of affairs at all. In fact, there is one other thing you can compare free cash or cash flow per share, and that's the earnings per share. Compare cash flow per share to earnings per share. Cash flow should be greater than the earnings per share, ideally. This leads straight on to the next thing to look for, and that is low net debt. As I mentioned a moment ago, a company with little debt is likely to be generating its cash without the need to go to the bankers or the stock market for cash. The ratio to look for here is the debt to equity ratio, and ideally this should be less than 2. Have a look at the trends as well, whether it's increasing or decreasing. Now, right at the beginning, I said that legally, dividends can only be paid out of profits. After all, a dividend is a distributable profit. No profits mean no dividends. It doesn't matter if there's cash in the bank, it just can't be distributed unless it's there as a result of making a profit first. You can imagine a company borrowing £1 million from a bank or floating on the market and raising £1 million that way and then immediately distributing that cash to its shareholders. It just doesn't work like that. You've got to make a profit first before you can distribute those dividends. So given that you want to ensure a company is making enough profit to sustain that dividend for years to come, ideally you want a company making at least 1.5 times its profit than it distributes as dividend. A company that distributes all its profits or even more than its current profits as a dividend is unlikely to sustain that level for very long before it just simply runs out of profit and cash to carry on paying out those dividends. This is called the dividend cover. The dividend cover figure is printed in lots of newspapers and it's widely available. So avoid companies, in my opinion, where the cover is less than say 1.3, 1.2, something like that. It basically means that the profit is only 1.2 times higher than what it's paying out in dividends. It might not be able to support that current level of dividends much longer and may have to cut them to carry on. I personally use Stockopedia to sift through the thousands of shares out there to get my dividend stocks. Take a look at the review on Stockopedia that I did not that long ago actually. I think they're a great way of simplifying that search for new investment ideas. But if you're not ready to fork out on a monthly subscription for data that they provide, then most of the information I've discussed is found in, say, broadsheet newspapers like the Financial Times, the Telegraph, the Investors Chronicle, platforms like Hargreaves Lansdown and Yahoo Finance. But my portfolio now pays me roughly £1,000 a month in dividends. They did take a hit in 2020 as dividends were cut back, especially with financial companies like banks and insurance companies that were instructed to suspend their dividends by the Bank of England. But this passive form of income is just ploughed back into buying more dividend stocks, so the portfolio is actually growing with compound interest year on year. It's eventually going to be the basis of my pension in later years, and the best bit, assuming the government doesn't change the rules, which it might do, the income is tax-free, which essentially means I get to keep a little bit more without giving a chunk of it away. In a future video, we'll have a look at how I actually choose a dividend stock using Stockopedia, so you can see exactly the process that I use. But until then, I hope you've enjoyed this video. Hit the subscribe button and the like button and the little notification bell as well, and I'll meet you in the next video. But anyway, I'm Anthony, and as always, we're talking money. Bye for now.